If you're trying to pay your home mortgage off as rapidly as possible, then this video may be able to save you decades of time. Hi everyone, my name is Ben and this channel is dedicated to all things personal finance, helping you earn more, spend less, and invest the difference. Now today we're going to be talking about one of my favorite topics, and that's real estate. Now personally, I like to keep my mortgages in place. I like to pay them as slowly as possible because mortgages typically have very low interest rates, and I just invest that money instead, hopefully at a higher rate of return. But I realize that not everybody is interested in doing it that way. Some people love to pay down their mortgage as rapidly as possible just for the peace of mind, because once you own your home outright, ain't nobody able to take it from you. You don't have to worry about the bank foreclosing. You don't have to worry about, potentially losing your job because you don't have to pay rent. You don't have a mortgage. Like, your bills are extremely low. So just that safety and peace of mind knowing that your home is paid for. So obviously the first thing you got to consider if you're trying to pay this home off rapidly is make sure that the home that you pick is actually reasonable based on your income. If you want to go out and buy a McMansion and your income is not very strong, then you're going to be struggling. You're going to be paying on that house for a very, very long time just because you bought a super expensive house. Personally, I recommend spending absolutely no more than 33% of your gross pay on housing. Now, when I say on housing, I mean your total combined mortgage cost. So things like your property taxes, your insurance, your mortgage payments, your principal and interest, your HOA if you got it, like everything should be no more than 33%. So hypothetically, if you make $60,000 a year, that's $5,000 a month. You would just take $5,000, multiply that by 0.33 or 33%, and you would come up with $1,650. No more then that is what you should be paying for your house. Now, once you've found a budget-friendly house that you're interested in buying, there's really only two things that affect how rapidly you can pay down that mortgage. So the first one is going to be your interest rate, and the second one is going to be how rapidly or how much additional money do you pay every month beyond the minimum payment. That's it. There is no secret sauce. Lower your interest rate, raise your monthly payments. So how can we do either of those two things? So the first one, lowering your interest rates, you want to make sure that you have a good solid down payment for this house. I recommend about 20%. And the reason 20% is typically that's what a lot of banks want before they start charging you PMI. PMI is private mortgage insurance, and most banks are going to charge you this additional fee if you are putting down less than 20% down on a house. Essentially, since you're putting down less of a down payment, you're a riskier borrower in the bank's eyes because you're not putting up a lot of collateral. So in order to compensate for you being a risky borrower, they're just gonna charge you a higher rate. And PMI can be pretty expensive on the grand scheme of things. Now, your exact PMI rate might vary, but it might be somewhere between like 0.5% or 1% additional interest on this house. But that can add up to a ton of extra money. Usually it's somewhere between paying an extra $1,000 a year for every $100,000 of house cost that you're borrowing against. So if you're buying an average price home, $200,000 or maybe $300,000 national average, something like that, you could be paying several $1,000s of additional money every year just towards this PMI. So I highly recommend having at least a 20% down payment to be able to avoid this additional fee that lenders are going to charge you. Now, sometimes I get it, it can be hard to come up with a 20% down payment. Because if you're buying a $250,000 house, 20% down payment means you need to come up with $50,000 in cash as that 20% down payment, and then you would have a $200,000 loan. I get it, it's a lot of money, but sometimes it can be worth it to save up that amount just simply to avoid having to pay this PMI insurance. All right, so the next thing that's going to affect your interest rate is obviously going to be your credit score. So as you're saving up this down payment, it is vital that you're doing everything that you possibly can in order to improve your credit score as high as it can possibly get. That way your interest rates, when you do finally apply for this loan, are going to be at the lowest rate possible. Because even small changes to your interest rate can make massive differences in your overall cost that you're going to be paying on this house. So for example, just a 1% interest rate difference, something between 3% or 4% if you're not a good enough credit score, just that 1% interest could be almost $2,000 a year in extra interest on a $200,000 house. That's a lot of money. You got to make sure that your credit score is as pristine as possible before applying for a loan. And the next thing, once you've got your credit score as high as possible, is you want to make sure to check the different loan products that your lender is offering. There's a lot of different types of loans that you can get. Some people want a 30-year fixed mortgage. Some people want a 15-year fixed, or maybe a 5-to-1 ARM. ARM standing for adjustable rate mortgage. Because the interest rates and the terms are going to vary, so you want to pick one that works best for you. Now, there is no universal one-size-fits-all as far as which one is the best product. I'm going to talk about the three most common, the 30-year, 15, and 5-to-1 ARM, and we're going to kind of go over some of the pros and cons of each one. So we're going to start with the 5-to-1 ARM, and as you can see, based on today's interest rates, at least according to NerdWallet, the 5-to-1 ARM doesn't really have very good interest rates, so at the moment I would not recommend it. We're kind of in some crazy times as far as mortgage interest rates. We're at an all-time low, but historically 5-to-1 ARMs tend to have really good interest rates. They're typically lower than the 30-year or 15-year fixed rate mortgages. So even though they're not a good option right now, if you're buying in the future, 5-to-1 ARMs typically have really good interest rates, at least initially, but you gotta watch out because these are adjustable rate mortgages. Your interest rate will vary. So typically if you were to apply for a 5-to-1 ARM, your interest rates that they're quoting you is gonna be locked into place for the first 5 years. And then every 1 year after that, the interest rate can change. Now there is a cap to how much the interest rate can change from year to year, so it's not going to suddenly go from 4% 1 year at the end of your 5 years to 10% or something like that. It is capped, but the interest rate can change every year after that. So it's locked in for 5 years and then every 1 year after that, hence the term 5-to-1 ARM. Now, typically a 5-to-1 ARM, since it usually has some super low interest rates, can be fantastic if you can pay this house down super rapidly. Like if you expect to be able to pay off the entire thing in 5 years or potentially 6 years or something like that, then this can be a fantastic option because you're taking advantage of those super low interest rates. But right now the 5-to-1 ARM doesn't make sense. Like I said, the interest rates for mortgages are a little bit crazy. So typically people look at the 30-year option or the 15-year fixed rate mortgages. Now when you're looking at a chart like this, the thing that you probably want to focus on the most is going to be the APR, the annual percentage rate. The interest rate probably doesn't matter all that much. So here's the difference between the interest rate and the APR. Because if you'll look at the 10-year fixed rate mortgage, you'll see that that has a really low interest rate. That interest rate for the 10-year is lower than the interest rate on the 15-year. But the APR for the 15-year is lower than the APR for the 10-year mortgage. So what's going on? What does all this stuff mean? So basically the APR is a more comprehensive look at how much you're going to be paying for a house. So it factors in your interest rate as well as any fees involved at closing. So while the interest rate for this 10-year fixed rate mortgage is really low, it's apparent that they're charging you higher fees than the 15-year because it's bumping that APR up, where suddenly over time the 15-year mortgage is actually going to be the cheaper mortgage. Now when it comes to safety and stability, a lot of people like the 30-year mortgage because since you're dragging those payments out over a super long 30-year window, the minimum monthly payment is super low on these things. So hypothetically, if we were going to buy that $250,000 house, we put up $50,000 for our down payment, so our loan is $200,000. At today's interest rate, we would be paying about $828 a month for the next 30 years for this 30-year fixed rate mortgage. But because we're not paying very much a month and we're dragging this out over a super long time, that's a super long time for that interest to be compounding. So over the lifetime of this loan, we're going to be paying $98,000 in interest. Ouch! Now on the flip side, if we change to a 15-year fixed rate mortgage, and as you can see, it had a lower interest rate than the 30-year mortgage did, and that's usually going to be the case. In a 15-year mortgage, since we're paying it off much more rapidly, the minimum payments are obviously going to be higher. In this case, we're going to be charged a minimum monthly payment of $1,317. But since we're making those higher payments, the interest rate doesn't have as long to compound, so we're going to pay significantly less overall in interest. In this case, we're only going to be paying about $37,000 in interest. So obviously the 15-year mortgage is going to have a lower interest rate. You're going to pay less overall in interest just because you're paying it off faster. But there is something to be said about the safety of the 30-year mortgage. Because what if you get laid off from your job? What if government lockdowns clamp down again and you just don't have an income anymore? Well, in a case like that, you still have to pay your mortgage. So if you're struggling, if something bad happens to you financially, it's a whole heck of a lot easier to come up with the $828 a month payment for the 30-year mortgage than it is for the $1,317 a month payment for the 15-year mortgage. Like, that's an extra $485 that you have to come up with when you're already struggling. So for that reason, sometimes the 30-year mortgage, even though you're paying more overall in interest, it can be a little bit safer just because in a worst case situation, your monthly payments are super low. So what some people like to do is go with the 30-year mortgage, but when times are going good, they pay it as if it were a 15-year mortgage. So basically what they're doing is they're taking the difference, that $1,317 a month minus the $828, and that's roughly $485 a month. So basically what they're doing is they're making this minimum monthly payment of $828 a month on this 30-year mortgage, but when times are good, they're also throwing in an additional $485 a month directly towards this principal, which is the same total amount that they would be paying had they gone with a 15-year mortgage. Now, since you're paying additional money on top of the minimum payments, obviously it's not going to take you 30 years anymore in order to pay this off. But because there was an interest rate difference between the 30-year and 15-year, you're not necessarily going to pay it off in 15 years just because you're paying as much money. Because remember, your interest rate is a little higher with the 30-year mortgage. So if you were doing it this way, if you had gotten a 30-year mortgage and then were attempting to pay it like a 15-year mortgage, so in that case, you would pay this 30-year mortgage off 14 years and 2 months faster. So essentially, you would pay it off after 15 years and 10 months. So it is still going to take you 10 months longer to do it this way than if you had just gone with the 15-year mortgage itself. But in a worst case situation, you do have the flexibility still to make those lower monthly payments, that $828 as opposed to the $1,317. So that is something to consider when you're deciding which type of mortgage you want to go with. So now that we've got the interest rate portion of this taken care of, the other alternative is simply paying more every month than the minimum required. Paying more than just that $828 for a 30-year, or paying more than a $1,317 for a 15-year. So how can we end up doing this? So the first thing, before you pay additional money towards your mortgage every month, you got to make sure that your overall financial health is in good standing. You want to make sure that you've got an emergency fund. You want to make sure that your credit card debt and your student loans and your auto loans and everything else is in check. You want to make sure that you've got enough money, because the worst thing that you can do is throw a bunch of money at this mortgage and then suddenly have a hiccup in life where you're suddenly struggling and now you need that money. It's not super easy to just get that money back once you've paid it towards your mortgage. So you want to make sure that you have a good emergency fund before you start making additional payments towards your mortgage. But let's assume that you've got enough money in a savings account tucked away somewhere, and now you're just worried about your checking account that obviously fluctuates as you get paid in your bills. So one way to do it is at the end of every month, set a minimum threshold that you want inside of your checking account. So hypothetically, maybe that's, I don't know, $1,000 that you want to have inside your checking account. Now, obviously, at the first of the month, once you get paid, that balance is going to spike up, right? But over the course of the month, while the bills are coming in, that balance is going to trickle back down. So one thing that I like to do is at the end of the month, anything above that threshold, that $1,000, simply put that as an additional payment towards next month's rent. So hypothetically, if on the 31st of the month, the end of the month, you have $1,700 in your checking account, then that's $700 above your minimum threshold. So next month, you would make your minimum payment plus an additional $700. Now you can set that minimum threshold to whatever you want, and obviously it's going to depend partially on how much you've already got tucked away in an actual savings account. So maybe 1,000 isn't enough, maybe you want 2,000 or maybe 500, it doesn't really matter. Do the math and come up with something that works best for you. And one great way to pay down a mortgage rapidly, and this isn't going to work for everybody, but what if you just got some roommates? Like, especially when you're young and you're just starting off, if you're not married, why not get some roommates to help you pay down your mortgage? The very first house that I ever bought, it was a handful of years ago, I bought it for $165,000. Now, after the down payment, my mortgage payment was $800 a month. The master bedroom was on the main floor, and on the second floor there was a nice little balcony loft area and 2 spare bedrooms along with a guest bath. So what I did is I turned that loft into sort of a second living room area, and I just rented out each of those 2 upstairs rooms to other people, and I charged $500 per room. So remember, my entire mortgage is only $800, and I'm collecting $1,000 in rent. So I'm essentially living for free because these 2 roommates are covering 100% of my mortgage and the overwhelming majority of my utilities. So I'm essentially not paying anything for this house. But you could just simply take that $1,000 a month that you're getting in rent and apply it as an additional payment on top of what you would normally pay yourself. That way you're paying $1,000 a month extra and paying this down rapidly. So if we go back to our example, and if we look at that 15-year fixed rate mortgage, if we paid an extra $1,000 on top of the $1,317 that we already owed, we would have saved 7 years and a month off of this 15-year mortgage. Like, we would have cut this thing almost in half. Now, I get it. Having roommates may not always be ideal, but if you did this and you started when you were in your 20s, just think about how liberating and financially free you could be by the time you turned 30. Like, this doesn't have to be a forever thing. Maybe you just do it for a few years to get yourself financially set. And after that, everything else is easy. If you enjoyed this video, be sure to subscribe, leave a comment down below, give it a thumbs up for the YouTube algorithm, and as always, I'll see you all again next time. Thanks.